Welcome back to the Stablecoin podcast. This is Luther and Rami. We're co-founders of Stablecoin Partners. Our guest today is Tanner Taddeo, co-founder and CEO of StableC, a stablecoin liquidity and orchestration company solving one of the most overlooked problems in the space. How do you actually get stablecoins out into the real world? StableC builds the infrastructure that lets businesses seamlessly convert stablecoins into local fiat across 40 plus countries. Today's conversation is about the last mile. Why the hard part isn't the blockchain, it's building the real world connections that make it work at enterprise scale. Before we get started though, quick disclaimer, the opinions expressed here are those of the hosts and the guests and do not represent the views of their employers or affiliate organizations. The conversation is for educational purposes only and should not be taken as legal, financial, or investment advice. And with that, Tanner, so great having you on the show.
Great to be here. Thanks for having me, and looking forward to the conversation.
Absolutely. Before we get kicked off, I mean, what a great day to have this show because you guys just announced a huge partnership with a well-known stalwart of traditional payments, dLocal. And so huge congratulations on that. We'll definitely dig into it more to the show, but wanted to kick it off with that huge announcement.
Yeah, thank you. We're excited for the partnership, and it's been great getting to know and work with dLocal over the past few months and quarters. And yeah, the future is bright in terms of what we got cooking up in the kitchen. So I think there'll be a lot of new announcements coming out as well. So excited for the partnership.
Fantastic. You were with Plaid and you were with Block in the past. What made you leave such amazing organizations to then go start something? What was that gap that you saw that was the impetus or that got you started with StableC?
Yeah. I mean, both Plaid and Block are great organizations, still have like lifelong friends there, and, learned an absolute ton about fintech and the underlying plumbing of financial infrastructure, both domestically, but also globally. One of the key insights that we had when we started StableC was that a lot of the stablecoin infrastructure that was being built, back in 2024 and 2025, a lot of the infrastructure was built for retail payments. So if you want to send consumer to business payments or business to consumer or peer to peer, essentially if you want to send high volume, low value transactions anywhere across the world, stablecoin infrastructure companies, both in the United States and also around the world, were popping up, and you could facilitate cross-border payments pretty seamlessly that way. One of the main challenges that we saw, though, is that there wasn't that many players that were building for B2B stablecoin infrastructure. And B2B is different than, business to consumer or retail payments, because you typically do low transactions, like per day or per week, but higher value. And so those tickets could range, $1 million, $10 million, $20 million, etc. And what we found at the time was that there just wasn't that much liquidity out there to pair against incoming inflows of USDC or USDT stablecoins. So if you wanted to do a $20 million trade between USDC and Colombian peso or Brazilian real, you couldn't programmatically off-ramp that. You still needed, no matter what liquidity provider you went through under the hood, you still needed to use an OTC desk for that. And for the listeners out there that are familiar or unfamiliar with OTC desk trading, you really how it works is you get a telegram number of somebody and you just call them, and that's it. And they could be anywhere in the world, and you could say, hey, I'm trying to offload 20 million, and then you're going to negotiate verbally for 5 minutes, and then once that trade is placed, they will give you a confirmation via Telegram or WhatsApp or insert your communication device of choice, and it just says, here's the confirmation code. That's it. So when you're moving that large of tickets and you get confirmation via a Telegram or WhatsApp message, there is no accounting and reconciliation. Essentially, like what you have to do if you're at a big organization is you have to screenshot that confirmation. You have to put it in Slack. You have to send it to your accounting team. The accounting team needs to send it to the CFO. By the time it gets to the CFO, they're like, what are we doing trading on Telegram? And you're like, that's an excellent question. So the whole concept of having a stable coin, making it be programmable, and we can dig into what does that actually mean. Everyone says that, is 24/7, 365 programmable, but what that actually means is you don't need a human to move these large tickets. And that's true for retail payments, but it's not true for B2B payments. So that was the initial insight that we set out to solve, was how do you create programmable money movement for high value transactions across the globe.
For those people that operate in the FX space and are listening to this podcast, I mean, almost every market out there has decent liquidity when it comes to US dollars, right? Like almost, I'm saying almost, right? When it comes to traditional US dollars, what was it that made USDC or USDT different? Because when we talk about stablecoins, we often say it's no different than a dollar. But why was the liquidity different when it came to USDC or USDT, even though that market potentially had good USD to local currency liquidity?
Yeah. I mean, there's two things. Like the paradigm shift that's happening is not really in terms of cost. Like cost is important, but like when you hear people say that stable coins are like free and like cost like they're cheap, etc. Like honestly, the traditional capital markets and like the traditional cross-border system is cheaper. Like it's really tough to compete with wholesale B2B FX rates that you can get from any major Wall Street firm, right? So from a cost perspective, that's not the actual value add. The value add is the settlement time. And so if you're settling in stablecoin, obviously that's instant. Instant defined as plus or minus 60 seconds, unless there's like blockage on like the Ethereum network or something. But even if you want to settle in local currency, so if you're sending to like South Africa and you want to settle in South African Rand, we at StableC, we do it 24-hour period. So because ultimately you're constrained by the in-country's traditional banking rails and like when a trade was executed, but you will always get your money within 24 hours of the time of execution. And what that, like, it doesn't sound like a big innovation, but if
Right.
you actually think about it, if you use any of the major Wall Street banks today and you use them for cross-border payments or treasury use cases, at best it'll settle T+2. Like even dollar mex will settle T+2 typically. And the reason for that is not because like any of the major Wall Street firms cannot settle same day. It's that they're trading for 48-hour period on the intraday volatility of a $20 million transaction. So like it's kind of their core business model is to make it wait 2 days so you
Mm.
can trade on that. And so that's how a lot of the FX spread gets taken out of the payment, because you're using that almost as like a facility to go and trade with for 48 hours, and then you settle it 2 days later. So, and that's for like the G20 currencies, right? Now, if you want to get to like Ghana, like in West Africa, and you want to do like Ghanaian cedi, like that's going to take 7 to 10 days to settle. And so if you're a big organization like a Coca-Cola or a John Deere or a Unilever, and you have like, take for example, I'm making this up, so take it with speculation, but let's just use like Coca-Cola as an example, right? Like they assume that they have n number of subsidiaries around the globe, call it 80 subsidiaries around the globe.
Okay.
Some of those subsidiaries are going to be loss leaders. Like if you have a bottling plant in West Africa, that's probably not making money for you, but you need to fund that operation. So you need to do a capital injection into some subsidiaries every month to make sure that they can make payroll, fix, manufacturing facilities if they break down, all the things. And then secondly, if you book revenue in a given country, like if you're a big publicly traded FANG company and you book revenue in Egypt, so you book revenue in Egyptian pound, every quarter you need to convert that back into US dollar, settle it on your balance sheet, and so you can report your P&L out to the street. So every month or every quarter, you have these large organizations that are sending money into and then repatriating funds. And the traditional Wall Street banks do that, at best T+2, at worst T+10, depending on the corridor. And if you think about how much money is just locked up in the correspondent banking ether, think about just the opportunity cost lost on $20 million that takes 5 days to settle. Just the interest alone that would accrue on $20 million for 5 days is worth something. And so that's the primary selling point, is not that it's cheaper for cross-border payments. It's that you can actually get your money same day. Same day defined as 24-hour period.
Yeah. I was nodding a lot because I resonated with almost every element of what you said. So myself and Luther both worked for big Wall Street banks back in the day in our careers. So I was at Citibank on the FX side, so I know exactly what you're talking about in terms of these payments and the time and the capital and efficiency of it all. But it's also a couple of things that resonated with me is that the argument around stablecoins, yes, quicker, faster, cheaper. It's not the cheaper. I agree. It's the speed of settlement. It's the speed of money movement and the certainty that the receiver will receive it in a time that is not 7 days. And lastly, yes, the Egyptian angle also resonates, being of Egyptian extraction. So yeah, it's not just about the accounting in that period, the volatility of the currency in that period. We've been in a period where the Egyptian pound is actually sort of devalued horrifically over the last sort of 5-6 years, or indefinitely, and it's not just Egypt, it's many countries around the world where, if you are an international company, you've got subsidiaries in many of these regions, having a synthetic dollar treasury for your global operation is much easier, and it's you're closer to doing that in reality by using stablecoins as that backbone. So I agree with everything you've said so far, actually.
Yeah, and it's a good, like, when you're going through a new technological paradigm shift, sometimes it's revolutionary and sometimes it's incremental. And it's okay if you stand on the shoulders of giants and you make, feature enhancements that usher in the next wave of adoption. It doesn't have to be this great, leap of technology. It can be just incrementally better, and that's going to drive a ton of adoption. And even some of those feature requests, even at StableC, because we route the vast majority of a cross-border payment is on a given blockchain, and we use select partners in countries for the off-ramp and payout. We track, we actually show in our dashboard where your money is at any point in time and who is actually holding those funds. So, if it starts with StableC in the US, we send it to one of our partners. You can see that it's held at our partners. When they do the FX and the payout, we show you where it goes, and we show you at every leg of the journey where your money is. And that sounds like something that people take for granted, but if you come from the Wall Street banks, that tracking money in a system via correspondence is super difficult. And I'll abstract the names away, but I'll share with you the story that there was a company I was at in the past, and we were doing a test transaction to a foreign country, and we were using a transaction banking desk a Wall Street transaction banking desk, and we asked to pre-fund that account. And so this was just for an internal product experiment that we were doing, and we asked them to pre-fund, a de minimis amount, like 50 grand. And how it worked was I would have to call up and say, hey, we need to do this transaction. They would confirm it, they would send it, and then there was no dashboard for any of us on the team to log into. And so 2-3 days go by, still nothing. 4 days go by, nothing. 10 days go by, and this is not an exotic corridor. This is a G20 country. And we couldn't find the money. And so called the transaction banking team back up, and they said, oh, it's lost in the correspondence system. And we were like, what do you mean it's lost in the correspondence system? And it was essentially flagged by one of its banks. So it touched 4 correspondent banks on the way to our own bank account in this foreign country. And one of the correspondents flagged it for not having the proper payment instructions attached to it, and then it got held at some offshore shadow bank where there's this entire world where if funds are stuck in the correspondence system, you need a neutral third party. So there are these shadow banks that just hold kind of frozen capital, and so then we had to go to them, and it was just it was absolutely a comedy of errors, but just to find 50 grand in the world, and you're why is there just no tracking system? But it's really difficult to do when you have 4 different correspondents on the in-between.
Yeah, I definitely remember that problem. We feel it every day, actually, to be honest. I think even I'm based now in the UAE, was previously based in London. And in the UAE, getting dollar payments, you think is actually quite simple. It's not, even though the currencies actually pegged to each other. It shouldn't be that difficult. But the one Wall Street banking system will input the SWIFT MT103, 202, it'll go through. But actually, because the reference might be slightly wrong, you're suddenly lost in the shadow banking. Oh, to be a shadow bank, how much capital would you have in that? That's the angle to be in. It's crazy. I think you remind me of an analogy of a previous guest that was on, where he said the innovation with Uber was not the was not the booking of the cab or anything. It's the map, so you know where your driver is, and you can see where he's coming, and you can walk out in perfect timing, like Kaiser Sose or something, just perfect timing when the cab rolls up. And I think that you highlight that. I think maybe it's not a revolutionary change, but it's a very significant incremental change, that the visibility and the transparency of the journey of money is now sort of being brought to at least B2B customers. They can see what's happening, and ultimately to B2C customers as well. Anyone who's interacting on the blockchain can see where the money is, literally, where is the money, which part of the transaction flow it's in. And that's powerful. I think just that certainty is quite good. I don't think we've got to the stage where like the programmability of the money, the supply chain finance, because I do think that's a good unlock as well, but I don't think we're really seeing that manifest itself so much. But this first stage of just knowing where the money is at all times on its journey to the places is a significant leap forward, I think.
Yeah. I mean, I think so too. And I think as like fintechs in general, like, I don't know if this is a contrarian take or not, but love a good contrarian point on a podcast. So given that we're moving into an AI era, code historically used to be a moat. And no longer is code a moat because code is writing code. So, in the fintech space, generally speaking, how you differentiate is on the basis of ultimately like brand and trust and functionality and latency. It's the worst interface you've ever seen in your life, but yet there's a real utility to it, right? Because they have network effects, they have ecosystems, people understand how to use it, and they trust those platforms. It's the same thing with the big banks. It's like, why would you use X, Y, and Z big bank when you could use all of these stablecoin companies that are moving money cheaper, faster, more transparent, yada, yada. But it's the trust element. That trust element hasn't
100%.
shifted yet. And so you need like the companies of the next generation of fintechs, need to really ensure that you have trust at the center. And trust typically comes with transparency by like showing who has the money, how much all the, like no hidden fees, etc., how much is gas, all of that, like transparency and trust, and then having like robust security and compliance protocols is really like the next era of differentiation in terms of like what we're seeing in the market. So I'm sure 1,000 people will tell me that that's the dumbest thing they've ever heard, but
I doubt that's going to be the case. But when you talk about trust, right? I mean, in the traditional fiat system, cash especially, you had barely any transparency into what the last transaction was. You have a little bit more visibility when it comes to just e-commerce or digital dollars, but the amount of transparency you have on chain is almost limitless, right? There are systems like Elliptic, etc., that can give you n number of hops, like unlimited number of hops, view into where that particular asset went. And that's, then the question is, if you have that kind of level of transparency, why isn't everybody jumping into it? And to your point, I think these are two things, right? One is change is always hard. And when you've built a whole system and a whole ecosystem around, all this in the SOP, standard operating procedures around sending a wire, reconciling, doing balances, measuring, and when you've built all that, you trust it. And so then when somebody comes in and says, don't worry, all that can go away, and you just need to, have an API call into this one system, and then you can send millions almost limitlessly. Then, there's a little bit of like adoption curve there. And I think that's where we are right now, is in this adoption curve. But you brought up an interesting point earlier about revolutionary and evolutionary. How do you view stablecoins?
I mean, I view stablecoins as as a evolution, because ultimately, I wouldn't say it's a revolution. It's like ultimately, it's still 1-to-1 backed by the US dollar, and you just now have a more convenient technological mechanism to share that data around the world. The interesting part is that even if you swipe your card at like a merchant, that's a digital transaction. It's you're essentially sharing digital data around the world, right? With your card in the traditional Web2 fiat system. And so in the Web3 system, you're still doing the same thing. You're just the data is represented by a different standard. That standard is a stable coin that's backed 1-to-1, held in a reserve someplace. So I think that it's more of an evolution for the next generation of payments and the next generation of how money as a currency of utility is shared around the world. I don't know if it's so revolutionary to the extent that it's going to upend existing systems around the world. And even in like the global financial space, I'm not sure if that's a good thing. like I don't know if you want to have a global disruption of the financial system overnight, i.e., within 3 to 5 years. That sounds like it's like impending disaster ahead, right? So I think evolution, like in some industries, yes, you want overnight revolution, but in some that touch businesses, global economic growth, individuals, etc., like we should move with clear-eyed confidence towards a goal. I don't know if we need revolution in the global financial system overnight. So, potentially hot
Yeah,
take there.
you're right, because if you or me or Rami were to hire a CFO or a treasurer for our company, you don't want the guy that's going to be like, I bet it all on black last night because I think we have the best odds of winning, right? You want the
Yeah,
most conservative, like it's going to take him, 18 months to evaluate and then maybe 10 months to kind of move kind of
yeah.
guy, right? Like, yeah, I completely agree with those.
Just on that point, there's just a funny, like where we live, there's a company 2 or 3 blocks away that's called Innovative Dentistry, and I was like, I don't want my dentist to be innovative. You know what I mean? Like they can just keep the practice of dentistry that they've been doing for millennia and just keep that going. We don't need any innovative practices there. So some industries, innovation can move slow.
I agree with you. One of the things that Stable C talks about and you talk about is having the best in market FX rates for stables, right? That has to have a really deep wells of liquidity with like really good partnerships. How have you guys built that network in a very short time?
Yeah, I mean, it goes back to the concept of trust, right? Because when we started out, we wanted to work with partners that had deep pools of liquidity that were also regulated in the appropriate ways, and that also had a strong halo of brand trust around them. Because what is a very common ask, and I don't think like a lot of people talk about it, but like if you go into an enterprise RFP and like you win that RFP, the first thing that they will ask is who are your downstream partners. So like, and
Right.
you're gonna have to share that, right? Because there's no way that like Fortune 500 company XYZ is just going to throttle 100 million via your API with having no visibility into like what's happening downstream. So from a enterprise perspective, you need to be able to come to the table with those partners, right? And the way in which you win those downstream partners' hearts and minds is by, again, trust, transparency, having like robust compliance processes in place. And from a technical perspective, like the technology has to be like there's zero margin for error on security and on ledgering, because like it's different. If you move $20 and you can't find it, it's not great from a product perspective, but it's okay. It's $20, right? And like
Yeah.
you have enough balance sheet, or it's like someone will get their $20 back. If you move $200 million, like you can't be wrong on that. And then also that value is so high that it comes under scrutiny for
Yeah.
the like when you're originating funds out of a country and the receiving country and the bank, like some of those levels of value coming in and out flag a whole bunch of stuff in the correspondent system, especially when you're getting back to fiat. And so it's making sure that like you have the right compliance protocols, the security around the infrastructure that's moving this value is airtight because there's zero margin for error there. And it's also inviting, the downstream partners into your process and being as transparent as you can with them. So, trust is not baked into a legal contract. It's not even given in a week or 2 weeks. It's built over time. And you earn that trust by, you know, transparently operating with them, quality communications, showing them your audit practices, your compliance practices, et cetera, et cetera.
Yeah. I mean, what and speaking of trust and partners, the dLocal partnership, I mean, that unlocks so much when it comes to local rails. Can you talk a little bit more about the demand side of that, right? Like, yes, people are moving USDC and USDT, but there's still such a huge demand for having actual local rails beyond just a bank account.
Yeah, I mean, big time. There's a few things that stuck out to us at Stable C about the dLocal partnership. I mean, one is the the shared sense of mission, like, and it sounds a little cheesy, but if you talk to anybody at dLocal, from someone that was just hired yesterday to their C-suite, they're all fundamentally aligned with this mission of putting people first and making sure that the financial system operates with a greater degree of ease and transparency. And the way in which we both got to know each other, and something that I appreciate deeply about dLocal as well is like, they're the type of company that, yes, they're publicly traded and yes, they're big, but they still are down to experiment. They still have this like youthful mindset to them where, we came to them with a certain problem. And, most big publicly traded companies would say, hey, we don't have time for this tiny little company to go build X, Y, and Z widget to see if we can facilitate 1, 2, 3. dLocal said, no, this is super interesting. And if we can unlock this, we can probably unlock a ton of volume. So let's just like dive in. Like we don't know either. Like they approach a lot of the problem solving and the technicality for cross-border payments with an air of humility and a humbleness about them. And so that's what we really kind of got off to the races of, just noodling on some technical concepts and like how we could marry our API design and infrastructure with theirs and what the art of the possible could be. So that's where we first really hit it off, was really on this like human element and then the mission. And then also, from a local payment perspective, we're still not in the era where you can send stablecoin and it settles on chain. Again, one of those things where, call me a pragmatist, but like, until you get to the day where I can send USDC to somebody in South Africa and they can take that wallet and go redeem it at a Starbucks or a local merchant, like the world is always going to be off chain. And it'll be stablecoin sandwich for the next 3, 4, 5, maybe even 10 years. And so as a result of that, like especially companies, if you think about B2B payments, most of the companies that use us today are using us for treasury movements. And so if you're moving a treasury, like you want to reduce your pre-funding times, so the amount of time that your money is just caught in the ether, but you still need to settle in local currency because you need to run payroll, you need to pay legal fees, you need to pay, your suppliers, etc. So you still need to get to local fiat. And when you get to local fiat, you need a partner that's going to be able to receive that USDC and do the FX. And so when you do the FX, you're going to need somebody that has a solid pool of local fiat capital that they sit on. And then second to that is you're going to need a partner that is built into the local banking rail. And so dLocal is best in class for both of those two things. And so when we started working with them, it was a natural fit.
One of the things that you guys launched in, I think, December is the API, if I'm not mistaken. Earlier, you described the whole OTC desk operation as being a Telegram DM, which is crazy to think about, right? That people are moving tens of millions of dollars using Telegram DMs. But if you look at your customers, how many of those customers are starting to migrate towards the API, and how many of them still send you a DM on Telegram?
Yeah, so no DMs on Telegram.
Good.
We can put that to bed. Yeah, the interesting part is we're getting a fair amount of demand for the API. Like, I guess the interesting insight is like when you serve the enterprise, an enterprise defined as like companies that typically they could be publicly traded, they could be Fortune 500, they could also have 50 million in annual revenue and be a steel manufacturer and like move money between Brazil and Michigan or something like that, right?
Mm-hmm.
So the interesting thing is that each one is different, and which means that you can't really build a platform that's going to scale to every like there's no self-serve about it. Like it's almost like a Palantir type model where we have off-the-shelf infrastructure that works, and we cover 40 currencies, and it's like all the functionality of like wallet issuance, FX APIs, orchestration APIs, payment instruction APIs, reconciliation, all those things are there. But then when you go into a supplier who's like trying to pay out a supplier in Brazil versus a big company that's trying to move their treasury to Kenya, those are two very different builds, because you not only like the wallets will need to be different, the ERP systems that both of those companies use will be different, not only in terms of the two different companies, but also the subsidiaries typically use different ERP systems based on like the sovereign jurisdiction that they're operating in. So there's a lot of bespoke building that comes with that. So all of our customers use the API, but in some instances, it depends on who we're building for. Like if you're paying out a supplier, typically an API, super simple, right? Plug it in, we handle the rest. For treasury movements, because you're dealing with humans and you're dealing with like a controller or a CFO or someone on the finance department, they want something that they can log into and click around. And they want something that honestly looks like a traditional bank account. And so we build those custom workflows for them based on what they want, based on what systems they want to plug into, based on what corridors, and then we build those custom rate feeds for them as well. So a lot of the stuff, it's not plug and play. Like for a general fintech that wants to build into our APIs, yes, it's plug and play. Here are the API docs, get off and running. But for a lot of the enterprises, like some want custom UI UXs, some want just an API. That API has to be built from a ledgering perspective, accounting and reconciliation, and like in number of different ERP systems. So it is, it is a bit of a slower roll when you work with the enterprise, just because there's inherently a lot of customization that comes with it.
Can you tell us a little bit about your customer base? So where are they geographically distributed? What kind of corporates are they? It sounds like it's a mix of different industries that they're in, but just give me a sense of the geographical split of your customer base.
Yeah, mostly North America. So we do a lot of flows North America outbound, so to speak.
Yeah.
So global north to global south. And then we also, so most of our customers are in the US, and then the vast majority of our flows are first party treasury payments. So it's to their subsidiaries, and their subsidiaries might be in APAC, LATAM, Africa, etc. So we really don't try and move towards third-party payments, because there's a ton of great providers out there today that you can go plug into and do payroll payouts, or you can do third-party payments or peer-to-peer payments. There's like a ton of great infrastructure for that already. And so we as an early stage company are really focused on like first-party money movements, and that has its own set of features just for that. So that's kind of where we're focused.
That's really interesting. And then I guess that maybe answers the next question I was going to ask. So we've talked about sort of dollar stablecoins as the origination instrument that powers most of these money movements. So that makes sense. If most of the companies are in the US, they're moving everything. It's going to start with the dollar stablecoin. That's the way we go out there. So how much interaction or how much of your flows utilize non-dollar stablecoins, or what are your thoughts on non-dollar stablecoins? How do you think that's going to grow, as part of this? If you think the stablecoin sandwich is going to be around for the next few years, what part does the non-dollar stablecoin play in it, or none at all? What are your thoughts on that?
Yeah, I mean, we don't do any of those flows today. Not saying that we don't want to. It's just there's two constraints for B2B, which again, like separating B2B versus retail. On the B2B side, there's just not that much liquidity in any foreign currency stablecoin, right? So like you've got Mexican stablecoin. Singapore came out with like the Sing dollar coin at the US or SGDX or something like that. Brazil has their own like private issuer of stables, etc. But the liquidity on any given chain isn't that great. Like, I mean, I could be wrong, and I would love to be wrong on this, but like last I checked, like the depth of liquidity is like $10 million max in any foreign currency stablecoin. So as a result of that, great for retail payments. Like for Stable C, if we do an $8 million transaction in a day, like we're gonna blow up that order book on chain someplace. So like we just can't pipe it through that yet. I mean, that said, that I do think on-chain FX is a really interesting and emerging area. I don't think the world is ready for it yet, but so long as the issuers of these coins are operating in the right regulatory framework with the right compliance protocols in their sovereign jurisdiction to issue those coins, and those coins are one-to-one backed in a bank in that country with that local fiat, then I think the world will move on-chain. And on-chain FX is super interesting, right? Because like then you can actually take that 24-hour, like the use case that emerges from that is like true instant settlement, unless you're settling in like USDC, which of course that's just, but yeah, even again, if you're settling in USDC, it's just an on-chain movement, so of course it settles instantly. And so there's no real innovation there, but I do think the innovation would be USDC on-chain to like Sing dollar, and then it settles Sing dollar in a stable coin that is one-to-one redeemable for like the Singaporean dollar in local fiat. Like that would be super interesting. And that's a really big innovation. Because today with the stablecoin sandwich, the local fiat gets settled within 24 hours, And so I do think that there's a world that'll come on chain, but it's still unclear to me, like when you're dealing with global governments around the world, the question always is it CBDC? Is it government issued? Is it private? Does it come from the private markets? And then if it's in the private markets, how do you create the right regulatory framework? And so each country, based on the philosophical kind of governmental ideology, will have a different take on that. And so it kind of goes into a little bit of geopolitics in some ways on like, how do you ensure compliance there?
Yeah, that's true. And I guess, Luther, in a good spot here because, at Stablecoin Standard, we have a range. We originally started for non-dollar stablecoins, and, I was at GMO Trust, which had a yen stablecoin issued out of New York, amusingly. So, we've seen how the regulation works. And to that sort of form of digital money being a political thing, Europe has had this conversation around CBDCs for a very, very long time. Now with sort of the environment in the US, effectively under the Trump government, as stablecoins are the proxy for a US CBDC. So yeah, it's interesting to see how that develops. It's going to take time, but liquidity is the key, which is sort of what you said at the beginning of the conversation. The whole outlook, especially in B2B payments, is all around the liquidity of the underlying and how quickly can you deliver that. So that's where I think the utility of non-dollar stablecoins needs to improve in order to get that relevant adoption. But when I first moved into stablecoins, Tanner, I thought stablecoin FX was the panacea. This is what we're looking to solve. And yeah, 3-4 years later, it goes back to the same issue, which is it's a liquidity issue and it's a trust issue around those providers. I do think we've made a lot of progress, though, in the regulation front. So I do think that in various jurisdictions around the world, they are, we're starting to harmonize or converge around the rules and the baselines for good stablecoins. What is a good stablecoin? So I think that will help with that trust element, but it doesn't work without liquidity.
I'm curious, Tanner, you said something, there is no instant settlement. Like, so in my head, and help me understand this maybe better, if somebody were to send, maybe not 10 million, but let's say 100,000 US dollars, and that convert to USDC, and that was being sent to Brazil, could that be settled instantly using PIX into somebody's bank account? Like, would that work?
Yeah, so I mean the caveat there is like in countries where there is RTP systems, then yes, you can have instant settlement, right? So like the amendment to that statement is yes, where there are RTP systems, yes, but the thing is for RTP, yes, 24/7 fiat settlement. But RTP rails are typically expensive. I mean, setting aside in like PIX and UPI in India and then faster payments in the UK, even if you look in the US, you've got FedNow and you've got the clearinghouse, both two different RTP systems. And they're still pretty expensive, right? And like RTP systems are also irrevocable. So because they're push payments only, they're not pull payments. And so there's a little bit more added expense, but yes, I mean, today you can do instant settlement, USDC to Brazilian real via PIX. And I mean, let's be clear, when we say instant, it's like within 5 minutes. So like, it's like not truly instant, but where there are RTP systems, stablecoins make a lot of sense. But where there are not RTP systems that are commonly adopted amongst the banks or the financial institutions in that country, it still takes time because you are dependent. Like we do a fair amount into Colombia today, and like Colombia, like we move money on chain instantaneously. So 60 seconds it is received and actually converted into Colombian peso. So the actual on-chain movement and the FX is done plus or minus 60 seconds. But the actual payout of Colombian peso to the in-bank account it could take 1 hour, it could take 24 hours because Colombia's country's banking system has a batch processing ACH system, and it does 4 batch cycles a day. And so depending on when the transaction was executed and the Colombian peso was converted into COP, or the USDC was converted into COP, it'll then get batched in a payout cycle. And the batch payout cycle happens 4 times a day during trading hours, so 9 to 5. So if you execute a trade at like 3 p.m. Pacific time, 6 p.m. Colombia time, it's not going to settle until the open of business the next day in the first batch processing. So like there's still, the inefficiencies don't reside on the Web3 side of the equation. The inefficiencies reside on the local banking rails side of the equation. And so, yeah, where there are RTP systems, though, you're absolutely right. You can do instant settlement.
Yeah. Bringing the conversation a little bit back towards the state side, one thing we have no clarity on is the Clarity Act, right? This whole thing is stuck on should stablecoins be yield bearing or not. How do you see that maybe playing out, and then also how do you see that changing how StableC operates?
Yeah, I mean, 2 things. As it relates to Clarity, I mean, there's a real battle between like traditional titans of industry and new titans of industry, right? It's going to be your Coinbases versus your JP Morgans, as you've already seen play out at Davos and other places around the media ecosystem. So, I mean, as it relates to Clarity, I think it's still a little too early to tell. I mean, I think that can stablecoins pass yield to their holders? In theory, that sounds really great. In practice, what that does macroeconomically, I don't know, right? So if you lose more market share to the banks and the deposits are getting, the deposits are leaving the banks, I don't know if that's a good thing overall to the financial system. I am definitely aligned with the Clarity from a perspective of we should do what's in the best interest of the consumer and or the business. And so if that means that like the banks now have to, pay yield on tokenized deposits, that's great, because like now the consumers are winning and you can make money on checking accounts and make money in savings accounts and all things, right? So I think the underlying nuance there, though, is like, a lot of the banks, when you take deposits in, it's fractional reserve lending. So it's not 1-to-1 like you have at like a Circle or a Coinbase. It's fractional. But the value add, and this is where it gets kind of like so metaphysical in some ways, whereas, you take all those deposits and you're recycling those in like debt instruments for like mortgages and auto loans and student loans and credit cards, et cetera, et cetera. And like the U.S. growth is typically, like the U.S. growth is fueled off of debt, for better or for worse, and or credit. And so when the reserves dry up, it's not just a matter of paying interest out to the consumer. It's like, well, what happens to the growth capital needed to facilitate debt for projects and communities around the country? And like that's where like it's out of my pay band, to be honest. I'm no capital markets expert, so I can't really opine philosophically on that. But I mean, that is, I think, the tension that's playing out. And it's not just a matter of like, is it, interest on yield versus not? It's not like as black and white as that. It's more, if you're a policymaker on the Hill, policymakers are typically incentivized to structure the future in 20, 30, 40 years from now. So, if you're like in NGOs, like when you sell kind of some sort of solution into the market, like you see immediate gratification because it's like, okay, there's a war and they need food and we're handing out, X, Y, and Z like protein supplements. There's immediate feedback loop. Businesses, you can take a 5-10 year horizon on things. We need to build this product, adopt it, all the things. Policymakers are saying, how do I architect the system in 20 years from now? So if you're a policymaker, it is not as simple to understand of like, do we pass on interest or not? Right. It's a lot more of like, how does actually lending and debt flow throughout the system? And what does that mean for economic GDP? What does that mean for the world? So I think it's a very complex issue. But I do think that like having stablecoin be able to pass yield onto its users is a good thing. Okay. And if that forces banks to innovate with their own products and offer yield on tokenized deposits or something else, then like great, consumers will win on that. So I do think it's a healthy debate to be had. I just think it's a lot more complex than folks read in the headlines of pass yield on or not pass yield on.
And you see the yield part of this, if, let's say that goes through, you see that changing the B2B space as well. I know you mentioned consumer, but you see that changing the B2B habits as well with stablecoin payments?
Yes and no. I mean, again, it's know your audience in a lot of ways, right? So like if you're, if you have a Coinbase wallet or some wallet out there and you hold whatever it is, $1,000, $2,000 in USDC, if you make yield on it, great. Like that's awesome for the consumer. If you're dealing with a CFO, like they, by nature and rightly so, they are the most conservative people that you will ever meet.
Right.
Not politically, but just like operationally. And same with like small business owners. You go and you talk to like an owner of a carpentry company that makes 20% margin. They got like 5 million in their checking account. Like they're so conservative with that money because like they need to be judicious with it. And what that means is that if in the B2B space, trust is being inculcated in stablecoins for cross-border payments. The demand that we get asked for a lot is we don't trade every day with these stablecoins. How can we generate yield? How can we put this money to work? Ultimately, is the question. And when the concept of stablecoin yield comes up, they're like, I don't know. Why can I make 4.25% or 5% interest on this thing? And like believe you me, the CFOs are way smarter than I or we ever will be on this topic because they know. Like I had a conversation with one the other day who was like, if I can get 4% on some stablecoin yield, but I can get 3.3% on my money market fund at BNY, I'd much rather take 3.3% because if I'm generating 4%, it's in some sort of junk bond or like in some sort of like security that is not as otherwise secure as what I can get in my traditional bank, right? So I do think that like to serve the B2B space, you're going to need most likely, I mean, let's see how the future plays out. I'm definitely not one to be an oracle of what the future will hold, but I do think like it'll probably be tokenized RWAs. I think if you think if you think about a risk-adjusted basis, if you can already convince somebody to trust stablecoins for payments, and they've demonstrated that they're willing to use it, the next leap is, okay, how do I put that money to work? But when you put it to work, it's going to be in a trusted brand like WisdomTree or Franklin Templeton or BlackRock or something like that. I don't think it's going to be hold in stablecoin and generate 7% yield. I don't know. Maybe I'm wrong on that, but we'll see.
It's a function of the things in the B2B space. It's a function of the products that they've already got access to. So your typical CFO's already got access to money market funds and this kind of product. So he doesn't need to chase yield. And like you say, by definition, they're conservative. It's already a leap to go digital in that sense. So they don't want to go any further. So yeah, absolutely agree. I think they will gravitate towards tokenized money market funds. I think that's where it's going to head for most of the corporate treasury community. But even then, at the moment, they're sort of inferior products to the analog versions at the moment, in terms of you go dive into them, they're not really as redeemable as they are during market hours. They don't have that 24/7 liquidity yet. So they still need a bit of maturity. But yeah, inevitably, if they're going to keep money on chain for their on-chain treasury, the on-chain treasury is going to have the stablecoin element for the payments part of it, and it's going to have tokenized RWA for the investment yield appreciation, that kind of yield preservation type of the business, I think.
Yeah. As we start to wrap up, what are some of the use cases that you're seeing the most prevalent right now? Quite often the ones that we see from our advisory side is payments companies, right, that want to avoid the pre-fund. We're starting to see trade finance companies who are starting to get into the, as you said, pay the supplier, right, like, or get some guarantee into if you are the seller and the buyer, like, getting instruments in place that were, traditionally letters of credit, etc. Is that still your main pipeline, or are you seeing new kind of categories of companies enter the stablecoin space?
Yeah, I mean, where we're focused is like we're focused on the real economy. And so the real economy, define that however you will, but we're really focused on getting traditional businesses, large and small, into the stablecoin and tokenized RWA and on-chain lending space. So for us, like philosophically at StableC, we're going through this technological paradigm shift where we're going from Web 2 to Web 3. What does that mean? That means that like money is becoming tokenized and RWAs are becoming tokenized and private credit's becoming tokenized and it's accessible on chain. And when you think about that, in the last 5 years, all of these great infrastructure companies have popped up. And they have, you've got Bridge and you got Morpho and you got Gauntlet and you got like just a great amount of innovation happening there. And the first adopters of those technologies have historically been technology companies, right? Because if you are an API company, you are necessarily selling your APIs to a developer. And if you are selling to a developer, the company is necessarily tech forward, right? Because they're going to review the docs and build it into some system, and you're off and running. But for us, like, it's how do you take this new generation of financial services that do have incremental gains to what you can get at your community bank, your credit union, your state bank, etc. How do you bring that to the real world? Because like the whole point, I guess in our opinion as Stable C, is like the whole point of creating new technology is that you can provision best-in-class financial services to the real economy. And if you don't, then you just have like efficiency gains being captured by a select sliver of the market, which just breeds a weird market structure like over time. And so the question is like, how do you take the best-in-class services that now exist in Web3 and make it really simple for, a steel manufacturer in Iowa that does 125 million in revenue? How do you make it easy for them to get an on-chain working capital loan same day? How do you make it easy for them to pay out their supplier in Brazil same day? How do you make it easy for them to have an AI agent that manages their free cash flow and parks it in on-chain RWAs, right? Like that is the world that we want to have come into the Web3 economy. So we're most focused on kind of real economy businesses, I guess is the long story long of that.
Yeah, no, that is, I think, ultimately where we're all building towards, is that instant nature of the availability of liquidity and reduce cost of capital, right? I think that's the ultimate panacea that we're looking for from that perspective. Where can people find you, Tanner?
They can find me on LinkedIn and my email and or within the network. I wish I was on social media, but I try and steer clear.
We'll definitely share all the right contact information and links on the show notes. With that, thank you so much for having you, Tanner.
Thank you very much. Thanks for having me.
If you're building in cross-border payments, this episode makes clear that the race isn't about issuing stablecoins. It's about who builds the reliable, compliant, global rails to move them in and out of the real economy. Please make sure you like and subscribe for the latest episodes, and if you found this of value, please share with a friend.